for the Indian market as global equities rally. The Nifty trades with gains of over 2%. Financials, metals and others lead the market, with frontline indices outperforming.
Strong second quarter business updates boost the HDFC twins. Mahindra & Mahindra Finance hits upper circuit as asset quality improves, while market share gains see IndusInd Bank rally and trade.
DMart posts record quarterly revenues in excess of 10,000 crore rupees, growth of over 35% over the last year. Marico, meanwhile, sulks after a muted update.
Vedanta rallies on a positive business update. A weaker dollar and global rebound in commodity prices also aids the up move in the entire metal space.
Goldman Sachs downgrades delivery to a sell, cuts the target to 480 rupees, citing an unfavorable risk reward. The stock, however, recovers from the lows.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, Mangalam, it's a good start to trade. A lot of those stocks that got pounded in the last hour of trade, they are bouncing back. Case in point being the Adani twins, Adani Ports as well as Adani Enterprises. Both of them are up and about in today's trading session. And add to the list a couple of those other names. Like Grasim is higher in today's trading session. But big boy, Reliance Industries, when that moves to the high point of the day, that's the one that supports the Nifty. It explains why we're up 350 points.
And not to forget that there are so many shorts in the system that were built in yesterday's trading session, that the fact that we held above yesterday and Friday's high meant that these shorts would perhaps scamper for cover. The question is what happens ahead of the holiday tomorrow and the second half. That is something we'll watch out for. But from where we are, we do have a technical analyst with us.
That's right, Mangalam. And in fact, those shorts in the system could be a bit of a blessing in disguise because they could be forced to cover out. So let's see how things move from here. But for the time being, Ashish Kayal joins in for a quick technical check. Hi, Ashish. Well, the bulls will be very, very happy. Yesterday, we didn't have a good close at all. But today, the bounce back is equally sharp. How would you approach trade at around the 17,200 odd mark on the Nifty?
Hey, Mangalam and Nigel, very morning to you and to all the viewers as well. Yes, we had a very strong gap up opening and Nifty is sustaining there, and it's a rally of 300 points. I'm sure the shorts that are created around that 17,000 mark, the call OI was very heavy. They have already covered a lot of positions and there is further short covering possible. I think the index can head towards the level of 17,400. But since we are already up by 300 points, I'm not expecting it to go towards that 17,400 today itself. So use a dip towards 17,150 as an opportunity to possibly go long on the index for the target of 17,400, and then we can possibly see some kind of consolidation. So what we had about a week back was a very sharp decline that we saw from 18,000 mark towards that 16,800. Now we are trying to retrace that up move, and nearly around 50% retracement comes towards 17,400. So I think we should be headed towards 17,400. Use dips as a buying opportunity on the index as of now.
All right, 17,400 is the target right now for the near term at least, with intraday dips as buying opportunities. Individual stocks, what do you have on your radar, Ashish?
The first stock pick is going to be HCL Tech. This is going little against the medium-term trend, but I think the IT pack is possibly trying to bottom out. We are seeing some kind of double bottom formation, positive divergence. HCL Tech is also moving above its 20 days average. Now we are going to have a positive crossover as well. So I think this can be a bet where the downside risk looks very minimal and upside opportunity looks good. So the risk to reward ratio looks very promising. So HCL Tech, one can create long positions here, maintain a stop loss on the downside at 910, expecting a target of 1,020 on the upside. The next stock on the buy side is going to be Ease My Trip. We can clearly see a very strong up move in today's session, and the stock was just forming a triangle pattern. Possibly it can break out today and give a good trending move towards the level of 460, which is the target on the upside. Maintain 460 as the target, and the support is at 395. So as long as 395 is intact, I think Ease My Trip is headed towards that 460 mark.
All right, thanks a lot for that, Ashish, for stopping by and filling us in with your quick take on the index, as well as a couple of those trading ideas. We'll time to slip focus to our special segment where we get you a few ideas for profit from Money Control Pro. Nitin Agarwal of moneycontrol.com is standing by to tell us about a stock that is tracking rather closely. Nitin, take it away.
The company that I have chosen is Bosch, an auto ancillary company. There are multiple factors that make us bullish on this stock. On the back of a strong product portfolio and wide product range, Bosch enjoys a leadership position. It has around 75% market share in diesel injection systems. Secondly, Bosch has continuously been investing in technological innovation. That has led the company to attain the technological leadership among the auto ancillary companies. And in light of the upcoming opportunities in digital solutions, advanced electronic system capabilities, and electrification of vehicles, the company will continue to add new components in its portfolio. All these provide new growth avenues for the company. Thirdly, industry outlook is encouraging for Bosch. The fortunes of Bosch are directly linked to the commercial vehicle segment. The medium to long-term outlook for the commercial vehicle segment is very encouraging with the pickup in the economic activity post the pandemic. Further, a positive farm sentiment on the back of the normal monsoon is expected to boost the sentiment for the commercial vehicle. The company also sees a very good opportunity from the bus segment with the reopening of school, colleges, and other segments. Lastly, marked by the semiconductor chip shortage and the increase in the raw material prices, the stock price is down around 20% from its 52-week high level, making the valuations very attractive. The company currently trades at around 23.1 times FY24 projected earnings, which is at a discount to its long-term valuation of around 34.1 times. And hence, we believe the valuation is very attractive for the company like Bosch. And hence, we advise investors to accumulate this stock for long term.
Welcome back. A bunch of stocks doing extremely well in today's trading session, but Venus Pipes and Tubes is the stock on our radar. The company has announced a capacity expansion plan to increase production of their seamless tubes and pipes. To tell us more about the prospects of the business going ahead, we do have with us Arun Kothari, who's the managing director of the company. Thanks a lot, Arun, for joining in. The first question is basically, what's the kind of capex that you've lined up, or what's the kind of expenditure that you will do to increase the capacity? And concomitantly, once the capacity increases, what is the revenue potential of these businesses?
Just I will brief about that. Right now, company is operating at the level of the 1,000 MT per month in the SS pipe segment. In SS pipe, we have the two segments. One is the welded pipe, another is the seamless pipe. So we had planned earlier before the IPO, capacity increase from the 1,000 tons to almost 2,000 tons, or with the backward integration of the 800 tons. So indirectly, company was increasing the capacity from 1,000 tons to 2,800 tons. So further, after the IPO, company has decided further increase the capacity in the welded pipe segment, bigger dia in welded pipe segment. From the in welded pipe, there is a two process. One is the 312, another is the 358. So company is increasing the capacity in welded pipe segment in 312 segment up to 20 inch dia by the 700 tons. So in fact, total capacity of the finished goods capacity of the company will be 2,800 tons from the present capacity of the 1,000 tons.
Arun, we want to understand very simple details. What is the current debt in your books? That is your long-term debt and working capital debt put it together. And given that you're talking about your capacity going up by double and triple, what is the total capex that you're going to be incurring? And what does that mean in terms of a peak debt number? Very quickly.
Right now, company will be infuse the capex investment of the approximately 150 CR. Out of 150 CR, company is expecting that in the long-term debt, only 40 CR. Otherwise, from the IPO, we are doing the expansion from the IPO proceed only, around 110 CR almost. Or company will further, by the improving the capacity, company will able to put the capacity by end of the FY23 or first quarter of the FY24.
But you're not telling us what is the current debt in the books.
Current debt is the including the long term as well as the working capital, yes. Both including almost 61 CR. 61
CR, and at peak, what does the debt go to? You're saying 40 crores out of this 150 crores will be debt. So from a total of 61 CR, what does it go to at peak?
Peak debt, including the working capital, we are looking approximately 125 CR at the maximum level.
All right. And what about, you said you're doing a fair amount of backward integration, etc. Where do margins trend from here? Because I'm looking at your margins over the last few quarters, they've trended between 11 to 12 odd %. So your entire capacity comes on stream by, say, the fourth quarter of this year, first quarter of next year. At peak, what is the revenue likely? And with all these backward integrations that you're doing, how much can margins improve?
Almost for the FY22, company has achieved the revenue of the almost 387 CR. For the last quarter, for the June first quarter of the FY23, company has achieved the revenue of the almost 113 CR. For this year, we are expecting almost the growth of the, compared to FY22, we are expecting growth of the almost 20%, FY22. Or going forward, once the capacity will put in the utilization, we are looking forward growth of the almost in FY23, 40% compounded growth for next 2 years, FY24 and FY25.
20% this year, 40% compounded over FY24 and 25. What about the margins? What happens? How do margins improve?
Since company will improve its company is going into backward integration, almost for the total capacity of the 2,800 tons, 40% capacity will be covered under the backward integration. So company will get the advantage of the backward integration also. For companies going to 8% companies manufacturing up to limited size of the pipe, limited dia size of the pipe. So going forward, we are manufacturing up to 56 dia size of pipe, which very few players in the India do manufacture. So both will improve the company margins.
Okay, all right. Just to try to get a quantitative number, the last year you did margins of close to around 12.5%. Now, given that volumes are going to increase, you're talking about some backward integration as well. Where do you see this margin band headed, say by FY25? Can it increase by around a couple of 100 basis points? Is that possible? And the second question that I asked you was on the revenue front. The guidance that you're giving 20% growth in FY23, that is on revenues, right? That's
yeah.
Okay, go ahead, sir. What about the margins? Could you quantify it? Around 15% is something you could do, 14%. How much can it improve basically?
On blended basis, we can say that almost from the compared to FY22, on blended basis, almost 400 basis point can be improved in the FY24, or further it will going forward 100 basis point will improve in FY25.
400 basis points is what you're saying. So basically, FY24, you're looking at margins at around 16% from 12%.
Yeah.
Okay, all right.
Yes.
So that's a rather large number then, Arun. You're looking at good margin expansion. So that's going to be predominantly because of higher volumes as well as backward integration. We get that. Give us a few more numbers then. What is your current market share in both the divisions? That's the stainless steel pipe market as well as the welded pipe market. And given that you're expanding capacity, where does this market share go to?
Almost on the blended basis, right now we have the 5% market share. After this expansion, company is expecting that almost 12 to 15% will be company market share in SS pipe industry.
Okay, and you're looking at 12 to 15% from 5% currently.
Yeah. Right.
And, is the market available to absorb the kind of capacity expansion that you're doing? Can you give us a sense of the macros of the market that you're operating in?
Yeah, in SS pipe industry, which are in Venus, very few players are in this type of industry in India. Or since the last 2 years, there's a lot of change in since after the Modi's announcement, Make in India concept, the lot of import has been restricted since last 2 years. So whoever company is manufacturing the SS pipe in India, their product is, since import is reduced drastically, so market share of all the domestic company has increased. Or going forward, import will also reduce since government is planning to put the anti-dumping duty on some of the pipes. So lot of the Indian consumers will require to procure from the Indian players only.
Okay.
So there is a good scope, or there is a good scope of the export also.
Okay.
Seamless pipe in the European market and other markets.
Let's take both those 2 points forward. Then exports are currently 10% of your revenues, right? Given that you're saying there's a good scope of expanding it, where does exports as a percentage of revenues go to in the next few years? Point number one. Point number two, that anti-dumping duty that's been proposed. It's, I think, a very wide range, a few $100 to around $3,500 odd. How much of your product portfolio gets covered by this proposed anti-dumping that is there? So both parts on exports, and how much of your portfolio gets covered? Go ahead.
In anti-dumping criteria, our total out of the total capacity, almost 40% products are covered under this criteria. Or going forward, we are focusing the export. Once our backward integration capacity will in operation, we are expecting that almost our export market will increase up to, we can say up to 100% in FI from the present 10% to, we are expecting approximately 20% market share in the top line in the next year in FY24.
So FY24 exports become 20% of your top line. At the same time, 40% of your overall capacity is currently protected by these anti-dumping duties. That's correct?
Yes, perfectly correct.
All right. Arun, before we let you go, you're talking about very large numbers and it's sounding extremely positive. But your promoter holding is around 48%. Wouldn't you want, given that things are looking so good, wouldn't you want to get at least to the halfway mark, maybe put it over that 50% odd? Any plans on that front?
Right now, we are focused since there is the right time for the doing expansion. Since there is a very increasing demand in SS5 industry, that's why we're diluting our equity. Or going forward, looking to the scenario and company cash flow, we can think in that matter.
Think of that. I mean, any promoter, if things are going to look so good and numbers are going to go up big time, you'll be happy, right? You'll want to go ahead and increase your holding. So will that be a plan at some point of time?
Sorry, will you repeat the question? Sorry.
Will you look to increase your holding in the company?
Yeah, definitely. Right now, we are not looking forward. Right now, we are focusing on the company front. We want to make the company at the very reasonable level. Once our company cash flow, first we want to make the company cash flow or company business volume. That part will come on later on straight. After 2-3 years, we'll think about that.
Okay. All right, take that point. Thanks a lot for joining in and giving us all those details of the company. The street was listening to you. They like the guidance that you've given, which is why we've seen a bit of a smidge on the way up as far as the stock is concerned as well. We'll step into a short break. On the other side, we'll get you more on the markets and individual stocks. First one is Avenue Supermarts, the one that I'm looking at right now. And that's because, Nigel, they've given their second quarter update and it looks rather strong. It's the first time that the company on a standalone basis has crossed that 10,000 crore mark in their top line. So that's a 35% jump year on year and a roughly 6% jump quarter on quarter as well. But the interesting part is that the first half of this year, they've opened 18 stores, 10 in the first quarter, 8 in the second quarter. Analysts are pegging anywhere around 40 to 50 stores being added every year. So they're on track for that. And in the last 3 years itself, they've added 118 stores. They have almost 302 stores right now. And the reason why, this is important is because the last 3 years were pandemic and the last 3 years were marred by a lot of one-offs, etc. Going forward, assuming and God willing there is no pandemic or any sort of uncertainty, this 30% of the company's overall ecosystem will start to deliver growth, and that provides it the kind of headroom that the analysts are penciling in. However, the only fly in the ointment for Avenue Supermarts has always been, ever since it's listed, has been the valuation. So it's 25% off its 52-week high, but still trading at extremely expensive valuations. But if the company can go ahead and deliver the kind of growth that it has been over the last couple of quarters, then maybe the valuations will sustain. All right,
Mangalam, thanks a lot for that. Well, let's focus on Vedanta. They came out with an operational update. Normally doesn't move the needle too much for them, but it looked pretty okay. If you're looking at the aluminium business, the Jasukta facility, well, out there you had a good growth of close to around 5% approximately. So that aluminium, remember, is bulk of their business. I think we should get some of these numbers up for you on the screen. 2% higher on a sequential basis as well, but Jasukta was up close to around 5%. The alumina refinery as well, that was struggling a little bit. So let's see how that impacts margins. Moving on to the integrated saleable metal, that's both zinc as well as lead put together. Out there was a good bump up of close to around 18% on a year-on-year basis. So that's pretty good going. And the saleable silver production, well, that is up by close to around 28%. So that is Hindustan Zinc, basically, both these two numbers. Moving on then, if you're looking at, the power sales, that as well was quite impressive. And out there as well, TSPL, well, out there, there was a good growth of more than 50%. And that's close to around 80% of the total volumes on the power side of business. So that as well was a positive read-through. A smaller part of their business is the international zinc business. Out there, Gamesburg, that's ramping up nicely. And that's where you had a growth of close to around 35%. Oil and gas continues to struggle a little bit, not yet been able to ramp up. But I think the street pretty much factored in that. The reason, though, that metals are doing well today is because of a couple of factors. Overnight, we did see that dollar index did cool off. And the yields as well on, US bonds, they cooled off a little bit. So both those two are normally positive for commodities on the whole. That explains why the stocks are moving higher. Well, a number of business updates have also come in from banks and financial institutions. Abhishek joins us to run us through more of that. Abhishek?
Well, to begin with, IndusInd Bank has given the business update wherein they have gained market share in the loan book. So sequentially, that is quarter on quarter, deposit growth is perhaps the best in 5 quarters and loan growth is the best in last 4 quarters. So deposit growth is of 14.7% YOY and about 4.2% sequentially, while the loan growth is at 17.6% YOY and about 4.7% sequentially. For the first time, M&M Finance has given a number on their asset quality in the business update. So the gross NPA over there has has improved to 7% when compared to 8% in the previous quarter. Disbursements remain strong. For the month of September, it was close to 4,100 crore, which is up about more than 9% on a month-on-month basis. The collection efficiency has improved 98% for the month of September when compared to 96% in August and 96% in June. HDFC Limited, the loans assigned is up 28% YOY but down about 4% sequentially. The dividend income was strong, up about 16% YOY and 98% quarter-on-quarter, while the individual loans sold is up 27% YOY and about 6.2% sequentially. On HDFC Bank, the loan growth has surprised positively, perhaps the best loan growth in 14 quarters on a YOY basis. So deposits are up 19% YOY and about 4.3% sequentially. The loan growth is at 23.5% YOY and more than 6% quarter-on-quarter. X of the pool that they have with HDFC Limited, the loan growth remains strong at 23.4% YOY and about 6.2% sequentially. The CD ratio has also improved, which indicates that the net interest margin may remain healthy. Back to you.
Take that point, Abhishek. Thanks a lot for that. So with that, we wrap up on this edition of Chartbusters with the news that we did have a fair amount of updates for the second quarter. The market's looking not so bad. The Nifty virtually at the high point of trade. Stay tuned. Trading Hour comes up next.